What's going on, guys? Today we're going to talk about an ETF that I really like and I'm going to, continually build out a position in. So let's go and look at this ETF here and talk about why I like it long term. You can see the website here. It's Schwab's US Large Cap Growth ETF. It's currently up over 700% all time. Let's scale back a little bit. The past 5 years, it's up almost 150%. Past 1 year is up 43.81%. And year to date, it is up 26.95%. So it has been absolutely killing it. Looking at, let's go ahead and go to their website. I think the holdings is roughly around 250, but pretty much those holdings are going to be, all large cap growth focused. Expense ratio is pretty competitive at 0.04%, so very cheap there. It looks like we are actually tracking an index, and that index is the total return of the Dow Jones US Large Cap Growth Total Stock Market Index. Some highlights: straightforward, low-cost fund, offering potential tax efficiency. Remember, ETFs are, a little bit more tax efficient than mutual funds and, your regular brokerage account. It can be served as a part of the core of a diversified portfolio. Simple access to large cap U.S. equities that exhibit growth style characteristics. Stocks that are classified as growth based on a number of factors. So it'll be interesting to see, what are some of those growth factors. I'm not sure if they'll disclose that or not. And another reason that I recently came, to this ETF and I wanted to build out more of a position in it is the recent update from Schwab and the stock split that they are going to implement. It's going to be a 4-for-1. So it's currently trading around $100, but it's going to, quickly go down to, $25, $26, $27 a share roughly. Once again, stock splits are not, nothing major changes. It's just the number of shares kind of multiplies there. You're still going to have the same NAV and, still investment amount. It's just kind of split up a little bit differently. Yeah, so currently around $100, 104.35. Started back in 2009. Yeah, so PE ratio is kind of high, but do remember this is it's a growth fund. Turnover rate's pretty low, so they typically just buy and hold. Sounds like holdings is 230 holdings. Morningstar category: large growth, management style, passive. Yield is low, so this is a growth play, so I don't really care about the dividends. Deviation, 22%, 3-year. So if we go into a bear market, there's obviously going to be a lot of volatility with this fund just because of, we're holding large cap growth stocks. So the 10-year average, it looks like, is at 13. I'm sorry, that's the Morningstar category. So it looks like 16%. 16.25% since 2009, so really good there. I'd be happy, if it can continue to perform like this, I'd be super happy, but we'll see. So here's a illustration of a $10,000 investment back in 2014. Would have turned into roughly $44,000. So pretty cool there. Okay, let's look at the portfolio. So pretty standard with a lot of these funds. You're going to get your Apple, Microsoft, Nvidia, Amazon, get your FANG stocks, growth stocks, which I'm all a fan of. Sector, information technology, it's pretty high. It seems like that's how a lot of these funds are, pretty high in IT or, So if you already have a lot of IT exposure, information technology exposure, you may just want to be aware of that this fund is pretty highly allocated to that sector. Looks like the second one is communications at 13.56, consumer discretionary, healthcare, and so on. And then, the majority of shares in that large cap there. Distributions, not going to be much of distributions here. It doesn't look like any short-term or long-term capital gains. And just remember, that's the cool thing about ETFs is that they don't have to distribute these capital gains. They can kind of just keep it within the fund. So they are going to spit out a little bit of a dividend, but nothing too major there. But yeah, guys, that's probably the rundown of this fund. I like that they're doing a stock split. Once again, it's not going to mean much, but you're just going to be able to accumulate more shares for cheaper. Is that a good thing? Is it a bad thing? I don't know. Psychologically, it's cooler to have hundreds of shares versus just, smaller amounts of shares with the more expensive funds. I don't think it will make a huge difference. Probably the only con is probably the bid-ask spread isn't going to be as great. And then also with this fund, they only offer monthly expirations. So as far as selling options, it's not going to be ideal. Plus the volume isn't real good. But that's fine. For this particular investment, I'm not really looking at selling calls. I might. But, I'm really wanting to buy and hold this fund for a really long time. If I can get some premium very far out of the money, great. But I don't want to, risk having to sell. But yeah, so roughly, on that note, it's going to take roughly $2,500 or so, probably a little bit more than that, post split to have 100 shares. So just keep that in mind. But yeah, guys, that's probably going to be today's video. Once again, this is Schwab's U.S. Large Cap Growth ETF, ticker symbol SCHG. Very cheap expense ratio, very competitive as far as index funds out there. So definitely go check it out, SCHG. And just once again, this is not financial advice. This is for educational purposes only. Just kind of want to document my thoughts and my opinions on stuff and what I'm interested in investing into.